Have you been curious about investing or trading in the stock market but don't know where to start? You see endless people online making a fortune through the stock market and you want to learn how to do this yourself. In this video, I'll share everything you need to know about the stock market as a beginner like myself, whose goal is to learn how to trade consistently and profitably. I'll cover topics such as what is the stock market and stock exchanges, what is a stock, why someone would want to buy a stock, and how to get investing through a broker and different order types. Let's dive in. Before we get into the nitty-gritty details, let's start with the basics. What exactly is the stock market? Well, the stock market is a platform where investors can buy and sell shares of publicly traded companies. It's essentially a marketplace where buyers and sellers come together to trade stocks. The stock prices fluctuate continuously based on supply and demand, news, and various other factors. Buyers bid for stocks at a certain price, and sellers offer them at a specific price as well. When these two prices match, a trade occurs. A simple example to understand this would be going to a car auction. If you were looking to buy a car for $8,000 and the seller wanted $10,000, then your bid would be $8K and the offer would be $10K. Only if you decide to pay $10K or the seller decides to sell $8K would result in a trade occurring. The stock market is similar, where stocks always have a current bid and ask price that is constantly moving, and when these cross, a trade happens. Next, it's important to understand exactly what a stock exchange is and what the role of stock exchanges are. Stocks are traded on stock exchanges, which act as intermediaries between buyers and sellers, which provide liquidity through a regulated venue. Some of the most well-known stock exchanges include the New York Stock Exchange and the Nasdaq in the USA. These are open for trading during trading hours, which in the case of the NYSE and Nasdaq are 9:30 a.m. to 4 p.m. Eastern Time. These exchanges ensure that trading is fair, orderly, and transparent. For shares to be listed on a particular exchange, certain criteria must be met, determined by that exchange, such as a minimum number of public shares, market capitalization, income, assets, and so on. Their main roles include the following: facilitating stock trading, by providing a centralized marketplace for investors to buy and sell shares of publicly traded companies. Price discovery. Through constant buying and selling, stock exchanges help to determine the market price of a stock at any given time. Liquidity refers to how quickly an asset can be bought or sold without significantly affecting its price. Exchanges provide this liquidity, making it easy to convert investments into cash when needed. Market regulation. This ensures companies listed on the exchange adhere to disclosure and financial reporting requirements with transparency and accountability. Listing of companies. Exchanges provide companies with the ability to go public and list their shares for trading. This is done through an IPO, or initial public offering, which is the process of offering a company's shares publicly to investors for the first time. Market indices. If you've heard of the S&P 500, FTSE 100, Nasdaq Composite, etc., these are indexes that represent the overall performance of a group of selected stocks, which exchanges calculate and maintain regularly. So now that we know what the stock market and a stock exchange is, what exactly is a stock? A stock, known as a share or equity, represents a unit of ownership in a publicly traded company. When companies go public through IPOs that we discussed earlier, it divides its ownership into smaller units called shares, and these can be purchased by investors. Now you might be wondering why would companies want to do this? The main reason is generally to raise capital and provide potential for future access to capital, which helps for funding growth, where capital is essentially just money. Going public also reduces risk for the owners, as they will be giving up a percentage of ownership of the company by diluting through shares that are sold. However, this can also be viewed as a disadvantage if they want to retain full ownership of that company. Lastly, it provides liquidity if the owners want to sell a portion of their company, whilst also being able to negotiate better terms with banks and financial institutions through credibility purely by the fact that they are listed. To put this into perspective, let's use Tesla as an example. Tesla has a whopping 3.17 billion shares outstanding, and Elon Musk, who is the largest individual shareholder, owns 412.6 million shares. So he has a 13.04% ownership in Tesla. This leaves almost 87% of the company being owned by other executives, institutional investors, and individual investors like ourselves. Majority of their shares are actually owned by institutional investors, which include banks, investment advisors, asset management companies, and so on. They actually have the most impact on Tesla's share price as a result, if, for example, they all decided to sell their stake in Tesla at a similar time. Next, you're probably wondering, why do people like ourselves invest in stocks, and why would you want to own a stock in the first place? The first and main advantage is the potential for long-term growth and higher returns compared to your average savings account. Picking a good, prosperous stock with a growth vision can provide solid returns for investors, but at the same time, this comes with increased risks compared to a savings account, as just as easily as it could go up, it could come crashing down. Purchasing shares in a company provides you with ownership in that company. This is proportional to the number of shares you own relative to the total number of outstanding shares. Through ownership of shares, you gain voting rights in the company's affairs, with each share typically carrying the weight as one vote, which is important for matters like electing the board of directors or approving major company actions. Lastly, dividends. A dividend is a portion of company's profits that are paid out to shareholders in cash. If the company you've invested in earns a profit, it may elect to pay a portion of these profits to shareholders in the form of dividends. This amount is generally expressed as the dividend yield, which is calculated by taking the annual dividends per share divided by the current share price. It is worth noting that a company is not obligated to always pay a dividend, and if they are making a loss or the economy is taking a hit, dividends may not be issued. Now that you've realized you want to invest all your money into Nvidia and get rich off the AI boom, yes, robots will eventually take over, how do you actually buy a stock? Individuals like us buy stocks through a brokerage account. This is essentially a platform or gateway to the stock market for investors. A brokerage firm is the middleman that connects investors to financial markets by executing trades on their behalf. This is done by sending your order to the exchange when you've placed it and getting it filled. The reason they do this is to collect commissions from you, which can be a fee per trade, FX conversion fees when depositing and withdrawing money, account and inactivity fees if you aren't trading regularly, and fees for research or live market data. Now, there are plenty of brokers to choose from with several pros and cons. Some examples include Interactive Brokers, Fidelity, TD Ameritrade, Webull, Robinhood, and so on. Each of these have different fees and account conditions, so it's best to do your own research when deciding what broker you want to use. I will create a video at a later date discussing what brokerages are good and what I will be using to trade, so stay tuned for that if that sounds interesting. Once you've chosen your brokerage that you'll be using, you simply need to sign up and create an account, deposit money from your bank to the broker, and voila, you are officially ready to buy stocks. However, before you close this video and become rich, let me give you some more useful information on finding stocks and placing orders. Every stock that is listed on an exchange has a unique stock code that is used to identify that company. For example, Tesla stock is TSLA, Apple stock is AAPL, the S&P 500 ETF is SPY, and you get the idea. These are known as stock codes. When searching for these stocks, you can see what exchange they are listed on. Apple and Tesla are both listed on the Nasdaq, whereas Coca-Cola, for example, is listed on the NYSE. Although this has changed over the years, the Nasdaq is generally known for technology and innovation stocks, which are more volatile and risky, as opposed to the NYSE, which is perceived as more safe, stable, blue-chip stocks. Stocks are referred to as blue chip if they are issued by a large, reputable, well-established company who is financially sound. Most of the tech giants, however, are listed on the Nasdaq, which are considered blue chip stocks, so take this all with a grain of salt. Now that you're a professional in the stock market, you've finally found your stock using the stock code and are ready to place an order, I'll next go through the common order types you'll see when you want to place an order for a stock. When you hit buy or sell, you're met with a few of the following order types. A market order is an order to immediately buy or sell the stock. This guarantees that your order will be executed instantly, but the exact execution price is unknown when you place the order. A market order will generally take out the offer if you're buying or sell the bid if you're selling. It's important to note that if there are sudden market moves as you are placing your order or the last traded price is different to the current bid or ask, you may get executed at an unfavorable price. A limit order is an order to buy or sell the stock at a specific price or better. This price is specified when you are placing your order, and it means you won't get filled at any price above or below your buy or sell order. For example, if you place a limit order at $100 for XYZ stock, you will only get filled at $100 or below. So if the stock is trading above $100, your order will be live and resting, and when it drops below $100, you will purchase the stock, sometimes at a better level than $100 if there is a sudden drop in the share price. Lastly, a stop order. This is an order to buy or sell the stock once the price of that stock reaches the stop price, which is specified when you place the order. And after this price is reached, the stop order becomes a market order. For example, if you previously bought XYZ stock at $100 like in the example above, and you want to minimize your losses if it drops, you can place a stop sell order at $95. Once XYZ reaches $95, you will have a market sell order closing out your position for approximately a $5 loss. Stop orders are helpful for setting stop losses, which is used for minimizing risk, or using trailing stop losses to guarantee a profit if a stock has moved in your favor. For example, say XYZ is now trading at $110 after you bought it at $100. You can set a stop sell order at $105, meaning that if the price drops to $105, you will market sell the stock, locking in a $5 profit. However, if it continues rallying to $120, you continue to make profit on that stock and can amend your stop sell order higher to $115 or whatever you like. A quick note for beginners, you can actually sell a stock before you buy it, which is called shorting a stock. The best way to describe this is with an example. Say you think XYZ stock will go down and you sell XYZ at $100 going short. If XYZ stock goes down to $90, you have made a $10 profit and you can buy it back at $90 to lock in this profit. You don't have to own the stock to sell it initially, although short selling has margin and other requirements depending on your specific broker. Furthermore, losses from short selling are technically infinite, given a stock has an unlimited amount it can go up in price. I want to conclude by saying that now you know how the stock market, stock exchanges, stocks, brokers, and placing orders works, you should conduct your own research before investing or trading your hard-earned money. There are several ways to do this through fundamental and technical analysis, which I will get into later in other videos. If you're a beginner into trading or investing like myself, make sure to stay tuned for valuable information as I learn it, as I delve into learning how to trade the financial markets. I hope this was informative, and if it was, please like, subscribe, and comment. See you all in the next one.